Carvana recently announced their earnings for the last quarter, and a lot of analysts are saying it can be the Amazon of the car space. So this e-commerce company is an online retailer for cars, buy and sell used cars. And the e-commerce company has seen its sales grow exponentially since its IPO in 2017. And a lot of top hedge fund managers have large positions of this company in their portfolio. I mentioned it a while back on our main channel, but either way, this company has been doing extremely well, especially with everything going on in the pandemic. Used cars, people, don't want to spend as much money, so they look towards used cars. On top of this, people are looking to buy and sell a car, buy a car online, and Carvana has that as well. So as of the fourth quarter in 2020, Carvana was one of the top 50 favorite stocks of hedge funds, and the only stock with more top 10 appearances and a smaller market cap than Carvana's $21 billion market cap was a SPAC that a lot of people have been talking about recently, which is Lucid Motors and their merger with Churchill Capital, stock ticker symbol CCIV. And by now, Lucid Motors has a much higher market cap than $21 billion. So this is the lowest market cap stock that is the favorite out of many top hedge funds and just investment banks right now, a lot of institutional investors. So hedge funds with major stakes in Carvana are companies like Tiger Global. They have 6 million shares, about 8.5% of the company. Spruce House, D1 Capital, Lone Pine Capital, all these different companies comprise about 25% of the total market cap of Carvana. And what I like about Carvana in particular is that right now at a $21 billion market cap, it's going into an industry that is only going to continue to get bigger. Buying cars online is going to continue to be more and more important. We see Tesla. You can only buy a Tesla online using their website, and Carvana, especially with people looking to save money with used cars, Carvana is an ideal place for people to look to get cars. But, so on top of all this, with Carvana, a company like them, the more people that are aware of it, the more inventory they have, the more eyeballs and the more customers and more revenue that they could generate. So the more distributed their inventory is, the more inventory they have, the bigger they can get. So it's a virtuous cycle. More people who look at it, more people who list their cars on it. More people who list their cars on it, more people who will buy cars. So as they get bigger, it's just a virtuous cycle that keeps feeding it, and it keeps growing and growing the company. So according to FactSet, 65% of the analysts that cover Carvana give the stock a buy or overweight rating. None of them have sell ratings. And according to most analysts right now, the average price target is around $320 per share. Currently, Carvana's stock is sitting at $283.50 per share. Since its IPO, it has done extremely well. It is up, since its IPO. At one point, it was at around $20 a share just a couple of years ago. So it's over 10x since then. If you look in 2018, or even if you look at, earlier this year, earlier in 2020, they were at $29 a share. So they've 10x since early 2020, about a year ago. But analysts still think they have a ton of upside and can be the next Amazon of the used car space, Amazon of cars. And, you don't want to use this term lightly. I'm not just saying this because it gets annoying when people use this term a lot. But I really think that they do have a lot of potential. They have a first mover advantage. They are really differentiating themselves from their competitors, and they're just not like the other car companies out there. So let me know what you guys think of it. But this company, I actually do think at a $20 billion market cap has so much upside in the industry that they are in.